On today's show, we are going to talk about one of the biggest questions that I get asked, or we get asked all of the time, is if you had £30,000, how would you invest it in property? What would you do? So I'm going to ask you that rhetorical question. So 30,000 quid, all of a sudden you're a brand new investor, you've come into money, you've got 30 grand and you want to start in property. What strategy would you pick? How would you do it?
Well, this is a really easy answer for me because I think there's only one real strategy that works, and it would be to get lease purchase options. So I would go out and get a lease purchase option, talk a little bit about what that means in a minute, but let's just go through the high level principle. So lease purchase option, 30 grand, I'd go out, I'd find maybe 4 or 5 of them. I'd look to get a house secured at right now, 300,000. Every kind of property metric out there at the moment sort of says we are in for about 20% over the next 5 years. So 20% of 300,000. 25%. Well, yeah, let's be pessimistic. 20% of 300,000 is 60 grand. I had to think about that one then. So 60 grand, if you did 4 of them over the next 5 years, that'd be £240,000 worth of equity. If you did 5, it'd be 300,000. And then I'd buy them in 5 years' time. Job done, and the bank could probably lend me most of the money. So let's talk about lease options then. Yeah. Right. And I agree, it's a great strategy to get started. You might, £30,000 to be fair, if you're buying, people might say I'm going to do flips, I want to do, turn properties over and trade them. 30 grand isn't really going to get you there because you need 25% deposit, you need stamp duty now at 5%, you need your legal costs and your refurb costs. So lease options is a really, really good way of getting started. So let's talk about lease options then. So a lease option is 2 agreements, it's not 1. And a lot of people you might have seen on social media saying, you get a house for £1, you get a house for free and all of this stuff. You kind of can if you know what you're doing properly. So a lease option is where you agree to buy somebody else's property at a fixed time in the future, or have the option to buy it at a fixed time in the future at a set price that you set at the beginning of the deal. Yeah. So for example, one of our properties that we did on a lease option, we took it on for 5 years. So we did a lease for 5 years, which enabled us to trade it as a HMO, enabled us to do the refurbishment. It was all written in the agreement. We paid the owner £1,300 a month for the 5-year period every month. And then at the end of the 5 years, we bought it for £250,000, which was the agreed price at the beginning. Absolutely. And then 5 years on, when we came to purchase it, the property was valued at £340,000, I believe. So we had a huge amount of equity in the deal straight away. So that equity was put towards the deposit, which meant that it only actually cost us, I think, £10,000 to buy that house. Yeah, exactly. And that is a good strategy. It is a good strategy. I think what people don't realise with lease purchase options is you're kind of trading with time, aren't you? You're kind of like buying something in the future, but you're committing the owner to that price today. And that means then you create equity, your net worth goes up because you have the right to buy that. Now, if your circumstances change, you may not be able to buy it, but you could then potentially assign that to somebody else who could buy it. So it's still worth something to somebody else if it's truly below market value at that point in time. So you raised a couple of points there. So assignment. Yep. So when you have an option, it's always great to have the option to be able to assign that agreement to somebody else. And that's where a lot of people do this remote flipping, and they take on a property, they take it on an option, they will then potentially do that property up and then sell the option agreement onto somebody else. But don't forget, folks, that this is the option to buy, because a lot of people say, okay, well, it's all good and well if the market goes up, what if it goes down? So if it goes down, we don't have to buy it because it's the option to purchase, not the obligation to purchase. However, the agreement does stipulate that the owner has to sell it to us. So it is a little bit one-sided, but you know what? If the market goes up, we buy it. If the market goes down, the worst thing that's going to happen to the owner is that they've had £1,300 a month in our case, every single month, and they get the house back in probably better condition than it was when we took it over. Yeah, and I think it's not completely one-sided if you think that owner, if they sold that property today at today's market price, and they're going to sell the property to you potentially in 5 years' time at today's market price rather than the future price, they have had 5 years of rent, like you said. Now, make the maths kind of easy, you know, 12 grand a year, £1,000 a month, you know, over 5 years, that's 60 grand extra income they've had.
On top of the asking price.
On top of the asking price. And when do you sell a house and keep getting rent? You know, so it kind of, I think it just depends on your principles of explaining that to the owner, how they can actually get that done.
There's another thing as well that's really important for people that are watching and listening. Every option agreement has got stipulations and clauses in that you, as the investor, need to serve notice onto the vendor within a specific time frame in order to execute the option. If you don't do it within that time period, you lose the right to buy the house. And if the property has gone up in value...
Know what that man just said.
If the property has gone up in value and the owner gets wind, obviously they'll know, then they don't want to sell it to you, and they will then use that against you to take the house back and sell it themselves. So it's really important that the devil is in the detail, really important that you understand everything that's in that contract, because if you do breach... Now, I've got a real life case study here. An old colleague of mine many years ago bought his own house on an option, spent £80,000 on it. Now, going back 10 years, it's a lot of money now, but then that was a huge amount of money. But he only did it because he was buying it on an option. He failed to serve the notice within the timescale, and the owner took the property back and he lost all of his money.
Yeah, I think the key word to remember is before. If you just remember, before the option ends, you have to have started the process or have to complete the purchase.
The notice.
And then you have a time frame. So before is the key word.
As long as you've served that notice, then that's absolutely fine. Now, let's talk about where do you get these deals from then. It's all good and well, you know, talking about options and, you know, getting a house for £1 and letting the property grow in value and the equity pays for itself.
Yep.
Where do you get them from?
Well, I think that's why if you've got some money, and it doesn't have to be 30,000, could be 15, could be set up to 70 grand, whatever money you've got enough money to sort of get into the market, do some marketing, do some direct to vendor marketing, you know, perhaps,
using a lot of these technologies. I mean, that's probably for a separate conversation, but you know, what do you mean by direct to vendor marketing?
So I think if we come back to the lease purchase option, so whilst you're renting it for those 5 years, you've got to do something with that property, haven't you? So you would normally use a high cash flow strategy. So I don't know if you want to explain how you're going to use that property, because I think that helps us then explain.
Well, you can, a lease option are two very different agreements. Like I said, you've got the lease element, you've got the option element. Options can be used for loads and loads of different things. You can have an option on land whilst you're trying to gain planning permission, and then if you get it, you buy it. If you don't, you give it back. You can have an option to do a remote refurbishment on a property to control it and then sell the option on, so you never actually have to buy that house. You take on an option, you do the property up, and then you sell the option to somebody else for a fee. And then you can also use options for the reason that we do them for, and that's to purchase a property in the future that we're going to turn into probably HMO. You can use an option on a single let if you wanted to. You can use an option on the serviced accommodation. Yeah. We use it for HMOs. So our strategy is to take a property over. We have a minimum of 5 rooms because it doesn't really cash flow it doesn't cash flow very well at all for us any less than 5. So what we'll do is we'll lease the property during that 5 years. We'll have the right to turn the property into a HMO subject to any local restrictions, i.e. planning permission, Article 4 direction, which we'll cover on a different show. And then we'll turn it into a HMO and we'll cash flow it then as a HMO. But my question was, where do you get them from? You know, where, so...
Well, yeah, so I was kind of thinking that actually if you want to cash flow a HMO, if you want to do this for income basis in the short term, but also want to increase your net worth, your growth, you want to create that legacy, you want to cash flow it. So I was thinking, okay, existing HMOs. So it's much easier to go and find an tired, run-down existing HMO that's already been converted and then use that HMO to cash flow. So my thought was actually I'd go and find the register of existing HMOs.
We'll do a completely one show on direct to vendor marketing.
Yeah.
But the other thing is, just for the viewers now to give a little bit of context, the other bonus and massive advantage of buying pre-existing HMOs is that if you have a property you're interested in, and that property is in an Article 4 direction area, which means you can't convert a house into a HMO from planning class C3 to C4 without full planning permission, because that's been removed by Article 4 direction. If your property was trading as a HMO prior to the introduction of Article 4 direction and continued to be a HMO without any breaks, and the planning use class is being C4 all the way through, then that property is grandfathered and the planning permission will stay with that house. So you don't need to worry about having planning permission and local authorities with Article 4 direction, because you know you can apply for a certificate of lawful use and development just to prove that it's got the right planning, but you can then take on that property with the knowledge that you've got the right planning permission and you shouldn't have any comebacks.
Yeah. I think that's a really big advantage. The other one is that you've got no conversion costs. So if you've only got 30,000,
potentially,
yeah, if you've only got 30,000, you go and get an existing HMO. You then, if you put a lot of money into a lease purchase option, just be aware it's going to be locked in, because you can't refinance something you don't own. So that's why you want to probably use something called asset finance, or maybe use a bit of your 30,000 to do your marketing, but also to get a few of your legal costs done. But then you want to be sort of effectively using finance money, because otherwise your 30,000, your 70,000 is going to be locked in that deal. And that's why you want probably, we try and do HMOs to a really high standard. So you probably want to go and find a tired HMO and just do a kind of bit of a refresh the furniture, maybe carpets, kind of put a bit of design in. Maybe there's the odd bathroom or kitchen that needs redoing. Don't forget to go and ask the owner if they're prepared to contribute to that as well. And then you've got that whole existing HMO thing up and going, and you can cash flow it. So you could be bringing yourself in £1,000 a month profit, also paying your owner. So over 5 years, that's 60 grand in your back pocket, as well as then if you do 5 of those over the next 5 years, you've got something like £300,000 worth of equity. And if you've done 60 grand on one HMO, maybe you buy one a year, so you're not going to get 60 grand for each one, but as you go through those years, you kind of cash flow through it. So
let's talk about cost involved then of setting up lease options. So very often people will say, or you might have heard, you can buy a house for £1. What they're referring to is a lease option, and what this actually means is that every option, because it's a deed, it needs a consideration, and the consideration needs to be of some form of monetary or exchangeable value, i.e. £1 or a peppercorn, which is actually still legal tender. Try that. I challenge anyone to go into a petrol station and try and pay for your tank of fuel with a peppercorn and see what happens. Don't tell them I sent you. So you could do this for £1, and that pound then will mean that it's legal, the consideration is £1, and it will be registered as a deed. But what we tend to do is, as the consideration, when we offer on a lease option, we will offer to pay the vendor's legal fees as the consideration, but we have to cap it. So we'll say, we'll pay your legal fees for the consideration of this option agreement to the value of £500 or to the value of £600. Now you have to cap it, because if you don't, and you say to the value of £1,000, guess how much the legal costs are going to be on the other side? It's going to be £1,000. So that's the consideration, and that's where the terminology "you can buy a house for £1" comes from. So is it real? Is it possible to get a lease option completely free on the other side by using the equity that the property might generate? How is that done? So if the property is purchased for 250,000, and then you have it revalued in 5 years and it's worth 350, you've got £100,000 equity, how do you then use that to set against the deposit when you purchase? Well,
it depends on your lender. So you need to then speak to your mortgage broker, tell them that you've got this property you want to purchase, it's on an option. It does really help then if you've done your legals properly, because normally the lender will want to sort of see the agreement, make sure that it has been, I suppose, bona fidely set up, and then you would then just go ahead, and normally they will have a calculation of how much they're going to give you. Sometimes it could be 100%, depends how much below market value is. Sometimes it might be 90% of open market value. It just depends. And I think criteria are always changing, so you can never quite guarantee the criteria that we have today are going to be the same in 5 years' time. But then you don't have the obligation to buy either. It's just the option.
There's two valuation methods, weren't there? They'll give you current on market value, or they'll give you purchase price.
Purchase price, yeah.
And it depends on the loan to value and the interest rates, etc., that they're going to give you on that.
So I want to ask you a question. Why would you buy property? Why would you do this now, right now? What kind of circumstances do you think you'd buy this, do a lease purchase option right now with 30k?
Well, I think with people, again, I mean, it's all down to money. Now, ideally, we want to purchase straight away, don't we? We want to buy now, we want to lock the money in, and we want to grow our wealth and our assets. But if you are on a limited budget, then it's a great way of starting your portfolio, refinancing at the end, and potentially getting your money back, all of it, and then going again. Now, it's also really good for people that want to get financial freedom, because you're locking your money in the future, hopefully, but you're also making a really healthy monthly cash flow. So, you know, some of our properties will do £1,300 to £1,500 a month. Most people in the UK would probably only need 3 or 4 maximum to replace their income or even get a better income. And then you've got the equity growth moving forwards. It's very risk-free, because if the market goes down in value, you've lost nothing. You've traded it for the period of the option, so you should be in profit anyway. And the market that we're in, HMOs, is so strong right now. Our rental markets are strong. We, since lockdown, haven't really had any voids in our portfolio at all. We went from having 17 during lockdown month to virtually none. So the market's strong. The strategy is stronger now than I think it's ever been. And then, of course, you've got the option to purchase it at potentially a reduced price in the future. So, you know, why wouldn't you do it?
And there is the cliche of buy property and wait, isn't there? So, you know, now is a good time.
Now is a good time. So thank you for listening. Thank you for watching. Don't forget, click on that like button, click on that subscribe button, leave a comment, let me know your thoughts. And if you'd like me and Mrs. G to do anything particular in the future in terms of property, if you've got any specific questions you'd like to bring to the table, stick them in the comments, and we'll get around to maybe answering them.
Yeah, it'd be great to get some new questions.
Thank you, Rain. See you later.